According to May personal consumption expenditures, that's PCE, as we know, it's the Fed's favorite inflation gauge. The rate of inflation in May rose by 0.1% month over month and 2.3% year over year. Those are both in line with estimates from Wall Street. But the big one, as we know, that's core PCE. That is Jay Powell's favorite. That is the FOMC's favorite. Core strips away food and energy. That came in hotter than expected. That's 2.7% year over year and up 0.2% month over month, both slightly hotter than economists' estimates. That was not the expectation. We'll see how investors digest that information. Let's hear what Mark Giambrone has to say. He's the executive director, head of U.S. equities, and portfolio manager at Barrow, Hanle Global Investors. Thank you for taking the time to join us. Give me your breakdown, top line PCE. Not what we were expecting for the core numbers. What's your expectation for the open?
Good morning. Thanks for having me on. You know, the core is a little higher than people expected, but I don't think it's an unreasonable number. And frankly, the Fed is currently on the sidelines anyways and talking about, pushing off anything that may help the market in terms of a rate cycle or cutting rates anytime soon. So I think the market's going to be okay with this number, although the trend clearly is something worth watching.
Is this just the tip of the tariff iceberg, Mark? We've been having this conversation for a long time. If and when did the impact of tariffs work themselves into the pricing figures? Are we starting to see it? Have we not seen it yet? Or are you in the camp that says, maybe we don't see it at all?
That's an excellent question, and I think it's the key question at the moment. And, the fact that we're getting some tariff negotiations, you just talked about the China deal, maybe with a structure around it. That's very positive because the longer it lasts, clearly there could be some impact. I don't think we've seen much impact yet. And frankly, I think the number today could be read as the economy is actually stronger than we think. That's one of the reasons why the Fed is still on the sidelines, but it's also one of the reasons why the market has been rallying this year. You talked about it being close to all-time highs. I think it's because underlying earnings and cash flows of these companies are actually very good. And we're going to see that as we exit the second quarter. And so while tariffs are clearly out there as a concern, right, as long as we continue to move through those tariffs and get some negotiations done, I think the market will be looking through that. I don't think it's currently inflationary, and it may not be, hopefully, if we can get through this without having to go back to a significant hike in the tariffs that are out there, or even maybe some paring back of the stated tariffs because of some negotiation.
Mark, every day here on Wall Street is unpredictable. Today, all the more so. Not just this hotter than expected core number. We got Russell reconstitution into the close, which promises to be volatile and unpredictable. What are you personally looking for in today's session on Wall Street? I said this on the show yesterday. Could have been one for the history books we just missed. That could be today, Friday, June 27th. Could be a day if we hit these all-time highs we talk about for a long time. What are you following?
I think what you're seeing again is the news coming through has been pretty positive, and the market is seeing macro things that are positive. Clearly, this trade deal is one of them. I would say the bill moving through the Senate now, the tax bill, is going to be very stimulative and positive for the U.S. economy. The market's starting to look for that to be happening in the second half of the year. And so, to me, futures are up. I think we're climbing the wall of worry, but those worries are becoming less significant, and we're moving closer to some positive catalysts in the second half of the year. I don't see a reason why the market won't end strongly today. It's indicated to do that, and I think the momentum is clearly there.
You mentioned the budget reconciliation bill, what the president likes to call the one big beautiful bill. On the one hand, you could undoubtedly see a big boost from equities, whether or not it's priced in. Do you have bond market concerns with regards to all the additional spending, the worries and concerns over debt and deficit? Hey, we've seen that bond market be more stubborn than the White House wanted to end up seeing a couple months ago. Are there concerns if that bill does pass on the Treasury side of things?
Absolutely. That is the one large concern, I would say, is, we're not cutting the deficit. Our initial intention, or so we thought around this bill, was to try to bring spending down. That's clearly not happening. The trend is appropriate, though, and what I mean by that is the House bill had significantly higher spending than the Senate bill has, and so it's coming down. And so the question is, where will we end up? It doesn't appear we're going to accomplish a goal of balancing the budget or bringing deficits in line. And so that will be a concern overall for the market and for the bond market specifically. But it appears as though as we're moving down this trend, the bond market and rates specifically have moderated or kind of, stabilized here, that would be good for the market if that were to continue.
I always used to say when I was a Capitol Hill reporter, everyone cares about debt and deficit until you become the party in power. Then you kind of maybe change the narrative a little bit. And we'll see what happens here. Mark, while I still have you, what is your bull case for the second half of the year? Are you bullish?
We are. I actually think the second half of the year, the first half of the year dealt with tariffs, dealt with, DeepSeek, dealt with a lot of negative things around the market commentary. As we move to the second half of the year, I think we're going to work through those things. Hopefully, we're seeing the China deal today. Some tariff situations will get better. I do think we're going to get this tax bill, which is going to be very stimulative, and we can certainly be looking forward into 2026 and maybe even retroactively what it means for this year. I think eventually, and we'll see with this inflation report, the Fed comes back into the market in a more dovish way. And so I think the second half of the year could prove to be very positive.
Mark Giambrone, are you kidding me? There is no better way to kick off our show today than with you as our first guest. Mark is Executive Director, Head of U.S. Equities and Portfolio Manager at Barrow. Hanle. Mark, thanks a lot.
Thank you. Have a good day.
You as well, my friend. It could be a busy one.